Hello everyone, welcome back. I got some really good ones for you today on this Friday, March 3rd, 2023. A lot's been going on inside the markets, economy, geopolitics, so let's dive right into it, shall we? Markets, the three major US stock indices, all had a pretty monster day today. Same for gold, same for oil. Cryptos fell under a little bit of pressure, but we'll discuss that. Essentially, over the last week and a half or so, risk assets like the stock market, oil, gold, Bitcoin, they've been under pressure. Because the 10-year yield has been rising from about 3.5% up to 4%. And as those yields rise, interest rates rise, the dollar rises, mortgage rates rise. We talked a lot in these videos how 7% is kind of the danger zone for real estates. As soon as mortgage rates go above 7%, that prices so many potential buyers out of being qualified. It starts to just push downward pressure on price tags for homes. So there's been a little bit of fear in real estate for sure with these rising mortgage rates and, falling mortgage demand. But we would have to fall another like 15 or 20% just to be where we were in like 2020. So, since 2020, real estate's had about a 40% run. I see 7% as the danger zone for real estate. As soon as mortgage rates break above 7%, things start to get really freaky. And then I kind of look to the Fed or somebody to start buying bonds, driving those yields down, driving those rates down, driving that dollar down, driving those mortgage rates back down. And that just pushes those home prices right back up. How come in, 2008, 9, 10, we had the great financial crisis and then we didn't have the inflation that we're seeing now?
Confused.
And we did see some inflation, but it came back down in those years following. I think this business cycle, so from 2020 on, is going to look a lot more inflated because we have a changing global order and because we never cleaned up our mess from the great financial crisis. So what do I mean by that? Well, when we went into the great financial crisis in 2008, 2009, and we dropped those interest rates down to 0% to kind of stimulate the economy, we forgot to raise them back up again in preparation for the next recession.
I forgot.
By 2015, 7 years after the GFC, the Great Financial Crisis, we need to be back at about a 7.5%, 8% Fed funds rate in order to prepare for the next inevitable recession so that we could cut rates back to zero. The bottom fell out of the dollar because in 2015, they still hadn't raised interest rates back up to a normal level, call it 5.5%. By 2016, nope. 2017, nope. 2018, 2019. And then we had the pandemic in 2020, so a financial crisis. And the benchmark rate, the Fed funds rate, was not back to 5.5%, 6.5%. It had only made it up to about 1.25%. So when we got hit with the virus in 2020, the Fed's first reaction was, we need to drop interest rates, but they were dropping them from only 1.25%. That's only 1.25. That's only 125 basis points of stimulation. It's going to be really hard to stimulate your economy with only 125 basis points of cutting. Basically, interest rates were already way too low going into the 2020 crisis. And then once that crisis hit, the Fed cut rates down to zero and started telling you, we're not even thinking about raising interest rates.
They won't.
And that created a lot of instability in the market because everyone went long. That's why the NASDAQ went straight up during 2020. Everybody was locked down in their homes, all adopting new technology and pumping their stimmy money into like Amazon stock and Google. Let me put this to you another way. If the virus had hit in 2020, and instead of the Fed cutting interest rates from 1.25% down to zero, they had risen them. Well, they had risen the interest rate. What would have happened is, because everyone was locked down in their homes and there was half as many goods and services in the economy during 2020 and 2021, You could have raised the interest rate, which would have drawn liquidity out of the system. And if you're drawing liquidity out of the system and you only have half as many goods and services in your economy as you normally do, that would have actually kept prices stable. So raising interest rates would have been good for the dollar, you know, and it would have kept inflation from getting completely out of control. But in 2020, they had already derelicted their duty.
I guess you can derelict my balls, Capitan.
And raising interest rates for that like 11 years prior. So they had already refused to clean their room for 11 years straight. And then we go into the pandemic, and then we have to, what, devalue the dollar on the heels of already devaluing the dollar. So the bottom fell out. And the Fed added 40% to the money supply in 2020, and prices need to go up 40%. Then we have the whole global order changing, right? Like maybe a lot of countries this business cycle, this next 10 years, are going to be looking to maybe not hold as many U.S. treasuries on their balance sheet, maybe looking for other alternatives. I did have a question from CEB2. What's up? Shout out to CEB2 about the U.S. implementing sanctions against China. What would that do for inflation? Well, the short answer, stoke inflation, and in my opinion, make inflation a lot worse. Anytime you have embargoes, tariffs, sanctions, it's all pretty much economic war, okay? So the way we have this like global economy set up is all these different countries have their respective comparative advantage, their things that they're good at producing and selling to other countries. And you might have a situation where America looks at China and, gets mad about something, whether it's like a virus leaking out of a lab or like, what they're doing to some of the minority groups in their country, or maybe they're floating the idea of sending weapons to their new friend, the Russians.
Who, me?
An embargo is like, you two, no more trading. You're not allowed to trade with each other anymore. Period, end of story. A tariff is just like, we're going to slap a tax on that. Any form of economic war, though, reduces cooperation amongst countries, reduces, volumes of trade, reduces a country's ability to leverage their comparative advantage with other countries. So it really is kind of like taking a poison pill.
Never go in against a Sicilian when death is on the line.
I'm not a big fan of any form of sanctions, whether it be tariffs, embargoes. Those generally don't work, and they're often a precursor to an actual shooting war, okay? So understanding why the inflation is sticky this time kind of requires understanding how from 2008 to 2020, we were being terrible custodians of the dollar, doing a terrible job of shrinking the Fed balance sheet, doing a terrible job of getting the interest rate back up to an adequate level for the next recession so that you would have enough percentage points to be able to cut to stimulate. So we didn't clean our room. We really needed to get ready for the recession we got hit with in 2020, but our room wasn't clean. Then we had to throw all that missing growth in 2020 onto the back of an already off-balanced and confused dollar. Have you noticed that none of these people on TV for talking about fighting the inflation fight and getting inflation under control, none of them talk about shrinking the money supply. None of them talk about rolling the Fed balance sheet back down to like $1 trillion. None of them talk about, raising the interest rate above the inflation rate, which is what you'd need to do to break the back of inflation. So they tell you, oh, there's this problem with inflation. Look, oh my gosh, who's going to save us? But the reality is they could do like all of these things to get inflation under control. But hey, we don't talk about that. It's all engineered and by design. The Fed knows exactly what it's doing. And valuetainment, Patrick said something, the host, cool dude. He said something about, when he thinks real estate's going to bottom and when he would really want to start doing deals again. And he says when unemployment hits 5%. So let's talk about that because I think he's actually onto something. Right now, the unemployment rate, it's like 3.5%. It's super low, okay? So unemployment is super low. Now, we're excluding people that like have dropped out of the labor force completely. So do understand that these employment numbers that you're hearing, they are fudged. They are a little bit wonky and fake to paint a rosier picture. But with that being said, unemployment is at record lows right now. And as the Fed raises those interest rates, you know, they're trying to fix the inflation problem, but they know as they raise interest rates, they kind of crush demand. And they've even kind of telegraphed that they're willing to accept a certain amount of unemployment to come as a result of these interest rate hikes. And so I would say if unemployment is 3.5% right now, which is a lie, but just put that off to the side. If it's 3.5% right now, maybe the Fed is going to allow it to rise to about 5%, which will also be a lie, but just go with their numbers. And once they hit 5%, they will have seen adequate falling of demand. You know, they feel like they will have gotten the inflation fight as under control as they could without risking unemployment going up to like 6, 7, 8, 9. The Fed does not want unemployment to go too high. Obviously, that kind of piggybacks on the whole they don't want to induce a recession, but they do want to get inflation under control. They will continue raising interest rates to do that. So I would say, yeah, if the Fed were willing to allow unemployment to go from 3.5% up to 5%, I don't think the Fed would allow it to go much higher. And then they would be done, you know, with their quest to solve inflation, and we'd probably be looking at rate cuts in order to prevent unemployment from going up to like 6, 7, 8, 9, 10% higher.
Thank you, Jesus.
So I think he could be onto something there. If unemployment hits 5%, I think the Fed is definitely going to throw in the towel on their inflation fight and then start to actually cut rates. So, rate cuts might not be that far off. I think we'll have maybe 1 or 2 more 25 basis point hikes to the Fed funds rate this year. And then by the back half of this year, if unemployment climbs from 3.5% to call it like 4.5%, 5%, that's going to kind of freak the Fed out, and they're going to stop raising interest rates. And as soon as the Fed, this is like the $100,000 question. As soon as the Fed stops raising interest rates, that's where you're gonna want to get all that cash to work, start making those deals, because as soon as the Fed starts cutting rates, those risk assets are going to do exactly what they did in 2020, in my opinion, which is to start to inflate. In 2020 or 2021, when Bitcoin was around like 58,000 or whatever, 60,000, that's because the 10-year yield was only 0.65%. So the lower bond yields go, the lower interest rates go, the lower the dollar goes, the higher these risk assets go. In the meantime, the Fed's going to fight inflation, with one hand tied behind their back. And as soon as unemployment hits 5%, they're going to start cutting again. That'll be the bottom for risk assets, and everything should start to inflate again. So, I think, tentatively, if unemployment hits 5%, that's going to be close to the bottom for risk assets, because the Fed's not going to keep raising interest rates past that. And in the meantime, between now and 5% unemployment, the Fed could start cutting at any minute now. And even if they don't cut, they keep raising. As long as the Fed balance sheet continues to inflate, as long as the interest rate isn't above the inflation rate, and as long as the Fed doesn't, raise capital reserve requirements for banks, well, then you're going to keep getting what you're getting, which is just, steady as we go.
Keep the change, you filthy animal.
That's kind of really all I got for you today.
That's all?
Thanks for joining me today. Like, subscribe, comment, share, whatever. You guys are awesome. If you could hit a like and a sub, that'd really help me out. We're going to keep growing this thing, all right? Till next time.
And it feels like me on a good day. Been talking to myself